Well, good morning, everyone. Thank you for joining us today. Welcome to our Empowering Women with Financial Literacy webinar, hosted by us, Northern Chartered Accountant. Today, today is all about bringing clarity, confidence into an area that often feels complex and overwhelming. Women already make so many financial decisions in their home, career, and businesses, yet the information available is not always shaped in women's in mind. Therefore, this session is designed to simplify the language of finance, explore the pressure women face, and give you practical insight that you can take immediately. Today, we're joined by three brilliant women who brings wealth of experience in finance, leadership, and business. Instead of me reading off their profile, why don't they introduce themselves? Yoda, would you like to start?
Yeah, sure. Thanks, Karen. So my name's Pani Yoda Viglas, and as Karen's just alluded to, it's Yoda for short. I've been in the accounting industry for 18 years now, at Norden's for the past 15, and a director here for the last 10 years. And I'm currently manage and head the accounts, all cloud and VAT teams here at Norden's.
My name's Keita
Peter?
Rains. I'm a commercial finance director and I work at Antares Finance. I've been a broker for just over a year, and previous to that, I was at Lloyds Bank for 20 years. So I've got quite a lot of commercial experience. I do specialise in property and healthcare transactions. However, I can cover all transactions.
And
Eleanor?
my name is Eleanor Vannerfjord, and I'm Swedish by background, but I have invested both in public markets, so in the stock market, and also in the private market at Blackstone before I started my own firm, Valhalla Group, which focuses on small and medium enterprises, private investing. And on top of that, I also have a Harvard MBA from Harvard Business School.
Wow. Thank you all. As you can see, you're all in very capable hands today. For anyone who is new to us today, Norden is an award-winning firm of chartered accountant and business advisors. We work with individuals, family, and businesses across the UK, transforming complex financial information into clear and practical guidance. Our focus is always on helping people make confident decisions with full-on learning and full-on just understanding. Our purpose is simple. Through innovation, inspiration, we aim to redefine advisory experience and uplift business excellence. Education is a big part of that purpose. We believe that financial understanding should be accessible to everyone, and today's session forms part of that commitment. Here is what we'll be covering today. We will explore what financial literacy means, the barrier women commonly face, budgeting and long-term wealth building, understanding financial terminology with confidence, practical tool for investing and saving, and how small steps today can strengthen your financial future. Each part has been shaped to give you clarity, confidence, real example that you can apply straight away. Now that we have our overview, I will hand over to Yoda, who will take us into the first part of today's session.
Thanks, Karen. So I did want to firstly talk about why we're running a Women in Finance session today. And we know that we have some men that have joined us today too, I believe. And you are, of course, welcome too. And I'm sure you will benefit from what's going to be discussed today. But we chose to aim this session at women for a reason. Across the UK, research from organisations such as HSBC and the FCA have highlighted a consistent trend. Women are equally capable financial decision makers, yet often face systematic barriers and structural inequalities. Women often face a very different set of financial realities: pay gaps, pension gaps, career breaks, juggling responsibilities, and confidence struggles. So today's session is not about excluding anyone, it's about acknowledging that women's financial journeys can look a bit different and giving them the tools to navigate those differences with confidence. So now that we've set out the need, let's talk about what financial literacy actually is and why it matters so much. But before we do that, We want to make this session as interactive as possible. So we've got a few polls for you guys today. So we want to ask you a few questions and get your responses as well. So if you can join in and answer those polls for us, that'd be great. We can get a feel for everything. So the first question is, how confident do you feel when it comes to investing? So would you say you're very confident, somewhat confident, or not confident? We'll just wait for a few people to answer. Okay, so 64% of us today have actually responded with six. Actually, that's amazing because 69% have said that they're not that confident. And research actually says that that is the common answer. So 69% of women don't feel confident about investing, even though they make complex financial decisions daily. So actually, we've seen that today's poll has actually answered that that's a worldwide thing. So we're going to touch on this throughout the session today about the confidence. But first, let's break down what financial literacy really means. In simple terms, financial literacy is the ability to understand and use financial skills that help you live the life you want and to be used today and in the future. And I want to emphasize that it's not about being an expert in the stock market or having a finance degree. It's about everyday skills that every one of us can learn and have in our skill set. So the financial literacy covers 5 fundamental areas. The first is budgeting. So understanding where your money goes and staying in control of it. And this is something at Nordens that we are consistently kind of drilling into our clients here. As setting budgets is essential to help businesses feel in control of its money, prioritize spending, and it allows you to set targets effectively and measure success against it. And then, so the second is saving, so building cushions for emergencies as well as opportunities. And then we've got investing, so making your money do the work for you. Debt management, knowing how to use credit wisely and avoid unnecessary costs, and planning for the future, thinking ahead about retirement, big goals, and getting yourself that long-term security. So, and although for those of you that are joining us today and you are running your own businesses, it's just like personal finance. Business benefit from the same simple principles. So saving helps create a cash cushion for emergencies or opportunities. Investing lets your resources work harder for you over time and grow the company. Managing debt wisely ensures that you can leverage credit without risking stability. And planning for the future keeps your business sustainable, helping you set goals, anticipate challenges, and stay competitive in the long term. So why is it especially important for women? Next slide, please, Karen. So, of course, we believe that financial literacy is important for everyone, but as briefly mentioned, it is especially important for women. And it's because the financial landscape, although in areas has come a long way, is unfortunately still not the same for women as it is for men. And here are a few of the realities that may surprise you, as I know they did me. So, the gender pay gap still exists. In the UK, depending on the sector, the average gap ranges from around 7% to 15%. So if you're looking at a salary of, say, 50,000, that's 7,500 to a hefty 3,500 to 7,500 pay gap, and that's each year. The pension gap is even larger. Research shows that women retire with around 35% less pension wealth on average than men. And a small portion of this is due to women retiring earlier, but it is mainly due to the pay gap and career breaks, often for childcare or for caring responsibilities, which can reduce earnings, savings, and pension contributions over decades. And another gap is due to the fact that women live longer. On average, women in the UK live around 4 years longer than men, which is obviously great for us, I guess. We've got 4 extra years, but it does mean that our money does have to last that little bit longer. And finally, and perhaps most importantly, confidence. Many women report feeling less confident in their financial knowledge even when their actual understanding is just as strong. So when we talk about financial literacy for women, we're not talking about nice to have skills. We're talking about tools that can directly influence your long-term independence, stability, and well-being. So now imagine the difference when women have strong financial literacy and confidence. The research is clear. When people understand money better, they feel more in control. Financial knowledge improves decision-making, reduces stress, which is so important in today's stress-inducing world. It increases security, and it creates more opportunities for women and their families. Women who are financially confident are more likely to invest, they're more likely to negotiate pay, they're more likely to plan for retirement, and more likely to make choices that align with their long-term goals. So what we're talking about is empowerment, not just financially, it's emotionally and practically too. So what are the barriers? Why are they getting in the way? We need to understand them if we're going to overcome them. So women tend to face 4 key types of barriers. The first being confidence barrier. So not feeling knowledgeable enough or afraid of making mistakes. Societal barriers, things like lower pay, childcare responsibilities, and traditional roles that historically place financial decision-making elsewhere. Practical barriers, so that's time, complexity, lack of clear information, or financial constraints. Psychological barriers, emotions like anxiety, avoidance, or perfectionism. So to avoid confusion here, I'm definitely not saying that these barriers are inherent. For example, women don't inherently lack confidence or strive for perfection, but these are behaviours that are mostly shaped by cultural expectations, family patterns, and even the way money is talked about. So the next is the confidence barrier. And as part of discussing the confidence barrier, I would like to invite you to answer another poll for us. So the question is, how would you describe your understanding of financial products and services? So would you say it's very good, reasonably good, basic, not confident, or would like to understand more? We'll let a few more people answer. Okay, so I guess the majority here is basic. So I've answered that as well today, just so I can get the answer. So if you see me, my answers popping up, it is because I want to see the answers as well, guys. So it does seem that it's basic, but that's great. That's why you're here today. Hopefully you can learn something. So in studies, only 58% of women rated their understanding as very good, compared with 72% of men. Not because women lack ability, but because of how complex the financial world is made to feel. And something that I find really interesting is that the Financial Contact Authority report that women often underestimate their financial ability. So research actually shows women scored similarly to men on financial knowledge questions, but significantly fewer said that they felt confident in making financial decisions. And 21% of women said that they lack confidence in finding suitable financial products and services, compared to 12% of men. So that's a fairly big gap. And from the research, it's not actually a knowledge gap, it's a confidence gap. And confidence matters. It's the difference between taking action and putting something off for another year. So societal expectations play a role too here. So next slide, please. Many women take on responsibilities like childcare, elder care, or managing household tasks. Combine that with a lower average pay and part-time work, and it becomes clear how financial participation gets limited. Sometimes not by choice, but by structure. These factors affect everything from how much women can save and invest to how consistently they can contribute to pensions. Over time, small differences compound into big gaps. And then there are the internal barriers. These are our emotional responses. Many people, especially women, experience avoidance. So I'll deal with it later. Just put the other next slide, please. Overwhelm, I don't know where to start. And perfectionism, if I don't do it perfectly, I won't do it at all. So I can personally say that I suffer with these traits in parts of my life. So I do understand these quite well. But the good news is financial literacy is a skill, not a personality trait. So mistakes are not failures, they are data. They are lessons, and every time we take a small step, we reduce the emotional weight around money. So next, I've got a bit of a case study just to kind of illustrate and share how how simple changes can make a big difference. So a client of mine, who I can now call a friend as well, we'll call her Sarah. Sarah is an incredibly competent and successful entrepreneur, but when she used to joke that she was bad with money. She loved to treat herself, shall we say, and didn't spend much time thinking about future Sarah and how she would ever get on the property ladder. So when she decided it was time to get serious, she came to me. We started with a few small steps. First, we created a simple monthly budget so we knew exactly what was coming in and what was going out. And yes, we did budget for a few treats, but just not as much as before. And once we had clarity, we worked out what was realistic to save each month, and we set up a separate savings account with an automated monthly direct debit. We set a target. We set a target for the deposit she'd need for the property that she wanted, and mapped out when she could realistically reach it. The timeline shifted a little bit, and that was due to the property market at the time, but she stuck with it and she did it. Now she knows how to budget, she saves automatically, and she's even investing in a few things that are doing amazingly well for her. And what changed wasn't her income and it wasn't her intelligence, it was her confidence around it all. So, how do we break the cycle? There's 3 steps. There's first is the awareness, so recognizing the barriers, naming them, and understanding their shared experiences, not personal shortcomings. Education, so building practical skills in budgeting, saving, investing, and planning. And action, so taking small, manageable steps that build momentum and confidence. Financial empowerment, as with any skill, isn't about doing everything at once. It's about starting somewhere. Start anywhere and then just keep going. So we all hopefully have the awareness of the barriers. And now we're ready for Keita, who's going to educate us in understanding the basics of budgeting and long-term wealth building.
Thank you, Yota. That was really insightful. Budgeting isn't about restriction, it's about direction. In this section, we'll explore how a simple, intentional budgeting system can unlock opportunities and accelerate wealth. Next slide, please. Budgeting is crucial for effective financial management as it helps control spending, save money, and also prepare for emergencies and achieve financial goals by ensuring your spending aligns with your priorities. The 50-30-20 rule is a simple budgeting framework. Next slide, please. That helps you manage your money by dividing it into tax-free income into 3 clear categories. 50% is for needs. So these are expenses that you must pay to live and work, which is rent, mortgage, bills, and groceries. 30% are for the wants. This is what Sarah did very good at, as Yotta's example was. It's the nice to haves that improves your quality of life, but they aren't necessarily essential. Eating out, going on holiday, entertainment, and hobbies. And then the final 20% is for savings or debt repayment. This portion goes towards improving your financial future and building up an emergency fund or even repaying extra debt and long-term saving goals. This flexible model helps balance essentials with enjoyment while still prioritizing financial growth. Now, many people carry some form of debt at various points in their lives. Now, what matters most is managing it properly and having a clear strategy in place. There are several ways to do this, such as consolidating loans, refinancing, or my very personal favourite is taking advantage of interest-free periods. Many lenders offer interest-free promotions on credit cards. Some can be as long as 2 years, and it can be useful when you're transferring existing credit card debt or if you've got a large purchase that you'd want to do. The key is to stay organised and have a repayment plan. So, for example, if you needed to spend 2,400 or if you wanted to transfer debt of 2,400, if the card that you had was a 12 months interest-free period, then you'd need to pay £200 per month to clear that balance on time. Now, if that's not affordable, it's not an issue. You can pay what you can, and at the end of that term, transfer the remaining balance to a new card with another promotional period. Whatever approach you take, always make sure you have a clear plan for when and how you will fully repay the debt. Next slide, please. Many people glance at their payslips or their bank statements without fully understanding the details. Now, the gross income is the total earnings before you have deductions if you are employed, whereas net income is your take-home pay, which is after tax, national insurance, and pension contributions. National insurance is really important as it supports state benefits and pensions, and I think this is where women sometimes fall down if they've taken long career breaks for having children, for example. Now, when you do review your payslip, make sure you check your tax code because that determines how much tax is deducted. It's important to ensure that you have the correct code. Recently, I learned that if you are a higher rate taxpayer and an employed person, you may need to claim back the additional 20% of pension contributions, which just goes to show that we're always learning. I've worked in financial services for over 20 years. Now, when we're looking at sending debits out, it's important to understand standing orders send a fixed amount of money from your account on a regular basis. You're in control of the payments and the time you can cancel them whenever you want to or amend them. Now, direct debits, on the other hand, they allow a business to take money from your account, meaning they control the amount that they take and the date that it's collected. Because of this, it's important to make sure that your direct debit date falls as your income is due. Otherwise, payments may be attempted and when there's not enough funds available and you will potentially get charged. So it's really important that if something isn't going to be available, the money's not there, just cancel it. On a direct debit, I would suggest always speaking to the company first. Don't just cancel your mortgage payment. Next slide, please, Karen. Again, we've got another poll. Now, awareness is the first step towards building stronger financial habits. This quick poll about your current savings behaviour will help us understand where you're starting from and identify any key areas that we can all grow. So just to give us a general idea, could you just say where you're personally at the moment? Renee, we're all kind of in that position, I think, and sometimes recognizing where you are in your current savings is probably the first step. Again, regarding pensions, really important to understand, and Eleanor will also go on to a lot of investings, which also looks at your pensions. So as we can see on there, there is a mixed area, but it's really nice to see that some people they are quite confident and they do have a buffer in place. Next slide, please, Karen. Now, you should treat your savings like a bill that you owe to your future self. Before you spend on anything else, move money into savings automatically. Set up a standing order from your main account, preferably on payday. And people save more when they can see the progress. So name those accounts: holiday fund, emergency fund, wedding fund. I got married earlier this year, and my partner and I, we put some money in an account every month whilst we were arranging the wedding, which meant when the day arrived, we had enough money to pay everyone. And it took that stress away of can a lot of people get out loans or have to get stuff from family. We was able to pay for it ourselves. Now that account is now a holiday fund. I've renamed it. So we continue to save every month and the holiday fund's building up so we can have another nice holiday after our honeymoon. Now, routines stick when they are manageable. So please just begin with a small amount and increase it gradually. Anything is important. Now, what you do need to do is create an emergency fund. An emergency fund protects you from unexpected events, job losses, car or house repairs. Now, ideally, your emergency fund should be 3 to 6 months of your essential expenses. So on the previous slide where we said 50% of your income is on essential, which is your mortgage, etc., try and aim for that 3 months minimum. How long will it take you to get there? Now, if that feels too big, just start small. Consistency matters more than the amount. So build gradually. Even £25 a week makes a big difference. Now, we all have coffees, we all have lunches. Kind of add up what you're spending in a week on those little things. You'll probably be surprised on how much it is. And can you kind of cut them down a little bit? As you do build up that fund, I would say make sure you keep it in an easy access savings account because it's an emergency fund. If you need the money, you'll need it now. So make sure you can get it as and when you need it. Once you've then built up that pot where it needs to be, you can start planning for the future. So you can then start going into a more of a long-term savings account, maybe a fixed amount, a higher interest rate that's maybe locked in. Next slide, please. Financial well-being isn't about being rich. It's about feeling in control. To reduce stress and regain clarity, start by getting visibility over your money. Track your income, track your spending, and check what's left over. Keep things simple by automating bills and setting up key reminders for dates such as renewals of like your car insurance, your home insurance. Don't necessarily pay them monthly. If you've got extra interest, put it on a credit card or something. Make sure you prioritize it correctly. And remember, asking for help is a strength. It's always better to address a financial issue early rather than putting it off. Again, hopefully that will make you feel better. Next slide, please. Here are some useful resources to reduce stress about finances and some recommended apps and support networks. As Karen said, she will send out the slide pack later. One thing I make a point of doing regularly is checking my credit file to ensure everything is in order. About 20 years ago, I applied for a role with a high street bank and I was successful. During their due diligence, the bank discovered that there was a default on my credit file, one that I was completely unaware of. The HR manager contacted me to clarify its origin. After some investigation, I discovered it was from a mobile phone provider. The provider hadn't sent out the SIM card for me, so when I received the first bill, I disputed the full month's charge, and at that time they assured me that it would be waived, and I didn't have to pay anything. Unfortunately, they didn't. But fortunately enough, the bank accepted my explanation, and then I was able to get the default removed. Had that not been resolved, it could have jeopardized my role in financial services. So again, something that I wasn't aware of could have had a massive impact on me, but was easily fixable once I identified the problem. Now, understanding financial language is one of the quickest ways to feel more in control of your money. In this next section, we'll decode common jargon so you can make smarter decisions with confidence. Finance can often seem complicated, full of jargon, acronyms, and technical language, but at its core, the concepts are actually straightforward. This section will help you cut out all of the noise, making money feel clear, manageable, and even empowering. Finance can feel overwhelming for several reasons, and the constant use of acronyms and abbreviations, the presence of technical terms that often obscure otherwise simple ideas, and the lack of clear, accessible explanations offered in schools or the media. So if we look at this table, assets are the valuable things you own, liabilities are the debts you owe, and your net worth is the difference between the two. In simple terms, net worth shows just how much you truly own after subtracting what you owe from what you have. I'd be interested to understand how many people know their number and if they do know their number at all. Inflation is the rise in prices of goods and services over time. When inflation occurs, each unit of currency loses value, reducing the purchasing power of money. Currently, the rate in the UK stands at 3.6, which is way above the government's target rate of 2%. An interest rate is the percentage you pay to borrow money or the rate you get on your savings, whereas the APR includes the interest rate plus most fees, giving a clear picture of the loan's true yearly cost. So you may get a really small rate on your mortgage, but the arrangement fee is really high. Do you know the difference? An ISA is a savings account that lets you save or invest money tax-free up to a yearly limit, which is currently £20,000. Everything you earn inside it isn't taxed. However, on the most recent autumn budget, the amount you can save in cash has been restricted unless you are over 65. Compound interest is earned on both your original money that you invested and the interest that it's already earned. This makes your money grow faster over time because each round of interest builds on a bigger amount than before. Next slide, please, Karen. There's some other abbreviations here. So your EBITDA is, if you are a business owner, it's the earnings before interest, tax, depreciation and amortization, which kind of gives the true income of the business before any extra things are taken off. Karen will send out all the slides, so I'm not going to go through all of them in detail, just conscious of time. Karen, can you go to the next slide, please? Preparation is the key to success, so it's important to start by mastering the basics. Once you have a solid understanding of the language of finance, you can ask more insightful questions, negotiate pay rise or contracts with confidence, and understand exactly what you're reading in bank, tax, and investment documents. This knowledge also allows you to discuss money openly and effectively with partners or business associates, giving you greater control and clarity in all financial matters. Next slide, please, Karen. Now, financial jargon often masks simple truths, making it harder for people to understand their own money. Clarity is key. It builds confidence and everyone deserves to have a clear understanding of their finances. Don't be afraid to ask, what does that mean? Because that's how learning starts. The more you read and the more you hear financial terms, the more familiar they become, making it easier to navigate the world of finances over time, and we can all get there. I'll now hand over to Eleanor, who will discuss investing and wealth in more detail. Eleanor?
Well, thanks so much, Kita, because now when we know how to budget properly, let's run through how to actually use that money for investing to build long-term wealth. Next slide, please. So first I want to go through the difference between savings versus investing. And first, the main difference is actually the time horizon. Usually when you're saving for short-term needs and maybe keep cash that you need today, for example, as an emergency fund, as Kita mentioned, versus investing is when you allocate money to grow for the long term. Secondly, a big difference is the risk level itself. Storing cash is usually low risk, low return in a current account or savings account, versus investing can involve higher risk, but also higher potential returns, something we'll touch upon on the next slide. And then finally, there's a difference in the purpose and the use. Investing is what we use for future goals and long-term wealth building. Next slide, please. So before we dive further into the section, I want to understand a little bit what's the biggest barrier for yourself right now to start investing. So let's launch the poll. Great. I hope people have had a chance to answer here. And I see there's a split between people not knowing where to start, fear of losing money, and not having spare funds to invest. And personally, for me, the biggest barrier was actually not knowing where to start when I got interested. So today I want to inspire you guys to find the right tools for that. Next slide, please. So to get comfortable with investing, let's first run through a few important concepts. And the number one most important concept must be the risk return trade-off. Generally, when you invest, the higher risk you take on, the higher the potential return. The lower the risk, the lower the potential return. So an example of a low risk investment would be, for example, buying a government bond. That might only yield sort of a 3% interest rate. So you're barely sort of investing your money here. However, also it's very unlikely that the government would go bust. So your money is probably safe there. A high risk investing could be, for example, investing in private markets in a startup. It's very low chance that startup will hit the unicorn standard. On the other hand, if you score $1 million and you pick the right target, then you'll earn a lot of money. Another high risk investing could be, for example, investing in a stock on the stock market, buying equity on a company. That also, there's a chance the company would go bust, right? But on the other hand, you could also benefit from the growth of that company. High risk, high return, low risk, low return. And then in the middle, we have index funds that blend shares from different companies, because it's unlikely all of the companies would go bust. One might do here and there, but if you have a blended index, you usually also lower your risk level. On to the next slide. So here we can see a few common investment options, and Keita already mentioned the very beneficial ISA account. So that is an account that you don't really pay any capital gains tax on. So I suggest, if you can, if you have the funds to do it, try to maximize the ISA account. You have a total allocation of £20,000 per year that you can invest. And as Keita also say, with the new government budget, they have limited the use of a cash ISA account to maximum £12,000 out of those 20. And that is to incentivize people to pick more high risk, but also high return yielding sort of assets, for example, stocks and shares, where you can gain more money and have a higher return in the long term if you have a longer time horizon. So that could be very beneficial to look into. Then, as the third option here, we have the ETFs, the exchange traded funds. And these are very beneficial as well, because these funds are diversified. When we spoke a bit earlier on the previous slide, when you're investing in many different companies, right, and have an index, that means it's very unlikely all of those companies would go bust at the same time. So you're diversified, you actually lower the risk in your investment by picking one of these already diversified funds versus investing only in one single company and put all your eggs in the same basket. And then as a fourth option, we have property. Usually property can be a medium to high risk investing. You can gain from sort of appreciation of the property that you bought. However, many people use a lot of leverage. They use a lot of debt buying the property, and that actually increases the risk in the investment. So just be mindful on how big of a mortgage you take out. And then finally, also we have pensions. And that is a long-term, very tax-efficient way of saving for your retirement. So also recommending allocating a bit to your pension saving. But having a blend of different investing options, that's usually a very safe way of remaining diversified. Once again, don't put all your eggs in the same basket type of mindset. On to the next slide. So here we have a bit of a summary slide for this section. Number one, set your objective, know what you're investing for. Number two, secure a safety net. As Keita mentioned, make sure you have an emergency fund and set some cash aside before you start allocating to investing. Start small. It doesn't have to be much that you're investing each month, but little adds up. And diversify, and finally review annually. So as your wealth grows, maybe in a year you can invest more than what you did today. On to the next slide. So now I want to really go through how the small steps today can strengthen your financial future for the long term. And on the next slide, we're going to touch up on the magical concept of compounding growth. So let's switch to the next slide. Yeah, there we go. And this is one of the great parts of investing, is that once you've sort of put your money into a stock, maybe into a diversified index, you earn money on that. You earn sort of an annual return. And usually on the stock market, you earn maybe 6 to 8% each year, depending on how the market goes. So if you actually invest £200 monthly, at an average 6% annual return, after 10 years, you'll earn more than £30,000. After 20 years, you've earned more than £90,000. And after 30 years, those 200 monthly investments will have become more than £200,000. And the magic behind this is really the compounding, that you earn return on the return that you've already earned. So it exponentially grows with time. So that's why actually starting investing early, that yields even more of a greater return versus you putting it off 5 years time. So try to at least allocate a little bit already today. Next slide. And where do you even start? Like, okay, you want to invest, you want to buy a stock, etc. But I think the number one step is to get interested. Like, really start caring about the markets and starting thinking of investment as something fun. And for that to happen, I think number one is like talk about finance with your friends. Like when you meet up for brunch, try to find other people that are also curious and want to explore, and then you can learn from each other by creating that community. And then also I recommend maybe picking up a book or start listening to a podcast to get inspiration from other people and experts in the space. And my personal favorite podcast has to be Acquired. They really do a splendid job of, for example, going through the whole history of a company. And usually those companies are traded today. My favorite episode is of LVMH, the luxury brand, where they really go through how it became such a giant that it is today and what really makes them sustainable and having this moat for the long term and remaining on top of their hierarchy. So I think that podcast is super interesting to dive into certain industries and build that interest. On to the next slide. And also, why does women excel as investors? Because this is a women's webinar as well. So I want to empower you guys, because studies actually show that women often outperform men in investment returns. And that's not through excessive risk taking, but actually through consistency and composure. So now I want to encourage all of you guys to go out there and buy one stock. And it doesn't have to be a big amount. Some stocks are trading for pennies. But just buy one stock, because what happens when you actually own a stock is that you subconsciously start following it and start caring about what happens to it. For example, if there's news in the market or your stock trades down, maybe you can figure out why did it trade down, or why did it trade up? What's going on? And here I've just put a snapshot of, for example, Burberry, quite a fun company to follow. And then you get to learn about why Burberry is doing well with the newest collection, or why not. So there's actually very fun companies out there to start investing in as well. It doesn't have to be bland. On to the next slide. And this is also a bit of a summary slide for my section. And I want you to sort of take a step back and reflect a bit on what is the number that you want to achieve in 20, 30 years when you retire. What wealth do you want to build up to yourself to sustain a certain lifestyle? And that will be very individual. Maybe you want 200K, maybe you want 500K, maybe you want 1 million. And then you back solve there, because you know if you invest today, you can count how much actually monthly investment you have to make in order to build that wealth. And then number two, think about what really gives you joy in life and see over your big cash drains each month. If you really care about living in a nice house or having a nice apartment, maybe you allocate a bit more towards rent. That's completely fine. But then maybe you cut down on other purchases or travel. On the other hand, if you don't really care about sort of your apartment right now and you want to treat yourself more and want to travel more, for example, maybe cut down a bit on rent. But you can't have all of the nice things at the same time potentially, because you want to allocate something for the future as well, so that eventually you'll grow into the lifestyle that you really want to have. And lastly, I would say buy quality over quantity. When making everyday purchases as well, you can actually think of it as an investment. Maybe you buy a coat that will last for 7 years rather than one that will only last for a season. That's actually also an investment, even if the coat might be more expensive, but you're buying quality over quantity. So you're buying something that actually lasts. Usually you end up saving money doing those decisions as well. So that's it for my section actually, and I'll pass it all over to Jota.
Thanks, Eleanor. That's really insightful, and you're encouraging us to go out and buy expensive clothes, is what I heard.
Yes.
No, I'm joking. No, I love. Yeah. That's what I heard. No, but I love your idea about discussing your investments with your friends and like getting excited about it together and being able to learn from each other as well. So it's really, really great. So I'm definitely gonna be doing that more myself too. So throughout this session, we've explored how to build financial confidence and independence through understanding what financial literacy really means, overcoming the common barriers women face, learning the basics of investment and wealth building, managing money, stress, and improving well-being, simplifying financial jargon. We've given tips on how you can take small, consistent steps towards the future and applying practical budgeting and saving tools. So how can we start today? How can you start today? So review your current finances and set 3 goals. Choose one new habit to implement this week. Open or review your ISA, pension, or investment plan. Track progress. Small wins build momentum. And reach out for advice when needed. You don't have to do it alone. And remember, building your financial confidence isn't about doing everything at once. It's about taking these small, consistent steps and moving steadily towards your future, the future you want. So your financial well-being is definitely within reach. So Keita has helped us to understand the jargon and the basics around budgeting, and Eleanor has encouraged us to get excited about investing. So you just need to take one step at a time.
So we're now moving into the question part of the session. If you have any question, please pop them into the chat and I will direct them to the right speaker. Please feel free to ask anything, even the simple thing. This is a learning space.
Sarah, I'll take your question
Yeah.
from there. What I would say is it's just regarding budgeting, knowing what comes in and what goes out. You could have £10,000 a month income and spend 11,000, or you could have £1,500 income and spend just 1,000. So therefore you're saving more. So all I would say is know what comes in, know what has to go out, the essentials, and know what you've got left. And if there's just a small portion of that that you can save, then I would start that. Also look at reviewing bank statements, direct debits. My husband, when we first got together, he had 3 mobile phone contracts, but he actually only used 1. We had 2 internet providers, don't ask me why. And he actually saved a vast amount of money by doing that, because sometimes the Netflix, the Disney, the Amazon Prime, yeah, they're £5, £10, but they all add up. You could save £50 a month. That's £50 a month savings potentially. So I'd say just take it back to basics.
There's one question. Any recommendation on platform to look into when considering investing in stocks? Eleanor?
Yeah, I would say there's many different platforms and try out the one that works for you. Personally, I use Hargreaves Lansdowne. They have a big selection of different both index funds and single stock, and that's been working well for me. But I think the platform is almost less relevant than just buy a stock, even if you buy it on Revolut. I'm sure that's a great first step just to get involved as well. But curious to hear Kita and Jota as well, which platforms you use and recommend.
Mhm.
I do Harvey's Lansdowne as well. I
Yeah.
think it's very important to understand, and that sometimes by going, if you were very new to it, Martin Lewis actually had a show yesterday and he was talking about investments and he was saying don't ever invest on something you see on social media, because if you don't understand it, you need to get somebody reputable.
Mine would be
There's
Revolut as well. I don't know. Sorry.
Nice.
Yes, okay.
Then we're aligned. Yeah.
There's another question. Do you recommend This went so fast. Do you recommend investing at first through an organized thing like Monzo investment?
I think we've just covered that question, Karen.
I think it was another question, basically. Yeah.
I think
It's
I
But I
think
get
honestly
the recommendation
the
would
app,
be, yeah.
yeah,
Sorry,
I
go
think
on.
the app, which app you use almost makes it's less important than just taking the first step. So if you have Monzo and you feel comfortable with the layout, then start there. You can always change another platform later. But then just it's a great way to try out if you already have app that you're comfortable will to try that one. And then there was a question also, where do you recommend finding out about ECS, bonds, stocks, etc.? I would say that dialing into the podcasts, everything from Invest Like the Best, Business Breakdowns, Acquired, that's a great way to learn all about different stocks and different companies. About ETFs and the bonds, there's also Wall Street Prep. That back in my career when I got started in banking, etc. That was a great platform where you also get to do a bit of modeling and get to download some free templates, etc. to get started with. So Wall Street Prep you can have a look at, Basit.
There's another question where it says, do you leave it even if it's going down? It seems to be recommended to not even look regularly.
Yeah, don't look regularly. I agree. Because the thing is that when we invest usually for a long-term horizon. We're not going to be day traders because that takes way too much time and they're professionals doing that. But for the long term, then it doesn't matter if the stock dips a little bit, as long as you believe in the company for the long-term trajectory. And usually the markets, they go up and down. But if you look at the S&P 500, sort of an index over the long term, that's when you really see the gain, even though in the short term, it can look very zigzaggy before it sort of trades up and trades down. So just hang in there, especially if you have a diversified index. I think the best part is, even if it goes down, just wait for sort of the recession or the temporary blip to clear out.
Do you want me to pick up Anna's question regarding pensions?
Yes, please.
I think it all depends on the age you are right now, what age you plan to retire, and the income you're going to need in retirement. Now, it's not really a calculation you can do in your head or on a calculator. A wealth planner would be able to sit you down and know where you are in your life cycle now, what plans you have. So, for example, if you don't have children yet, you plan children, and they will look at the retirement age, how much you need to live. So, if you need £20,000 to live now when you're 30 and you're going to retire at 65, that same 20,000 is probably 30,000. So I would say to either sit down with a financial planner or even go online and have a look at yourself and plug in some numbers. It's a good way to start just doing it on your own, but I would always say take professional advice. And depending who you work for, whether you're employed or self-employed, a lot of organisations match contributions. So the government guidelines are that employees need to put in a certain amount and you put in up to 8% as well, whereas some employers will match that. If you are self-employed, you can utilise your allowance every year and do that. So the more you put in, the better, but only put in what you can afford.
Very
Great
insightful.
advice. Yeah, very great advice, Keita.
Oh, we have another one about investing, Eleanor.
Oh, from Michelle.
Mhm.
I work with men mainly, and certainly it can be imitating when talking about finances, even though I feel like I have the knowledge. Can you give me any advice to get the confidence? Yeah, I can relate to that a lot, to be honest. I've been working mainly in sort of a male-dominated environment. And the funny thing is, I think it really is a confidence thing. So when you're having a chat with your sort of male colleague, if you start scraping the surface, you understand that they're usually on the same ballpark as you anyways. So I would just like really ask the question to them, like, and have a conversation and exchange ideas. Any advice to give that confidence? I think you just have to do it, unfortunately. And then outside of work, like get other peers that you can chat with, because sometimes when you talk about colleagues, it's also that you're in a certain system, you're in a certain institutional environment. But outside of work, maybe try to either connect with them there and connect with other friends outside of work to build that confidence when you go into work. But I think you have to be almost a bit uncomfortable. It's always going to be uncomfortable the first time you ask that question, and then you get more and more used to it. So
You have to get
you're gonna,
comfortable being uncomfortable,
yeah,
don't you?
you have to get
Yeah.
comfortable being uncomfortable. Unfortunately, I wish I had a better better answer, but just throw yourself out there.
But I think that you do have to just throw yourself out there, not be afraid to make a mistake or say something a bit wrong, because you'll learn from it anyway. So you can't be afraid of discussing it. And I guess do your research, like Eleanor said as well, listen to podcasts, kind of get your knowledge up, discuss it with other people, your friends and family as well, so that you're not going to be embarrassed too. So then you can feel more confident as well in the work environment, I think.
What I would say is it depends on what you want to discuss. So, for example, if it's investing, we've been speaking a lot about that. Get the book Investing for Dummies. When I started working in commercial banking, I didn't even know how to read a set of accounts. So I just got Accounting for Dummies. So I just put a book in the chat, and the For Dummies gets everything. And it starts off with the very basics and then goes up to the technology, to the more technical things. But you'd be surprised. The ladies and I had a conversation where we say that when women are applying for jobs, unless they can do 90% of what's on that job description, they won't apply. Whereas if men can do 10% of it, they'll apply. So in fairness, Michelle, you probably know more than they do, and they're probably just giving it the big one
to be in
and they
the
don't
role.
know. Yeah.
Yeah, so true.
Yes.
And we had the kind of a similar conversation before we started, didn't we? That about like it is very male orientated. So we're used to it. You just have to get more used to it, I guess, in the field that we're in, and just put yourself outside your comfort zone.
Michelle, and I think Keita has, provided a link to the Investing for Dummies edition book.
There's lots of different For Dummies books, so they are a good place to start when I want to learn something. Or Google. I Google everything. If I don't know, I Google it.
Oh, and we've got ChatGPT now as well,
Well, do we have any more questions? I don't think so. We are conscious of time. So if we cannot answer every question, within this live webinar, please note that you can still reach out to us. The following slide will include a QR code with our direct contacts if you guys want any more follow-up support.
Thanks, everyone.
Thank you.
So Anorden, we know financial confidence is something that you build over time. If today has highlighted any areas where you would like support, whether that is budgeting, planning, saving, and long-term strategy, our team is always here to help. As a next step, we will be sending a full presentation slide and a recording of today's webinar. These will be emailed later on this week to everyone who registered, including those who couldn't attend the live webinar. And finally, as I've mentioned during the question section, if you would like to connect with any of our speakers directly, you can use the QR codes on the screen. It links to their LinkedIn page where their contact detail will be displayed, so you can reach out for further guidance or follow-up discussion based on the section they've done. And lastly, we would love to stay connected with you. Feel free to follow Norden on our social platform, where we share education content, update, and guidance. Thank you again for joining us. We hope today has given you clarity, confidence, and practical steps for your financial journey. Thank you. Have a lovely day.